It's an arm wrestle, isn't it? Unfortunately, I think both sides now are waiting to see whether the economic pain that this is inflicting will force the other to concede. In the meantime, markets are more focused on earnings, in my opinion, and there the news has been good. Obviously, the consumer sectors are seeing some pressure, but the upgrades that we're seeing from tech and from energy are more than offsetting that consumer downside. And therefore, it feels to me like markets are increasingly trying to look through what's coming out of the Middle East. I think it's difficult, particularly when the headlines move so quickly from positive to negative. It feels like if at all possible, equity investors are trying to refocus back on fundamentals. But what we have to bear in mind is that the Q1 results are really not going to capture the full economic impact of this fallout in Iran.
Well, indeed, and we're looking at the PMI numbers this morning, much weaker than expected in the euro area, the composite reading pointing to a contraction in private sector activity. Now, the UK numbers were actually very strong, all performing better than had been expected, and services and manufacturing both growing. Are we setting essentially markets up for a fall with the economic prospects souring as they are?
I mean, I certainly wouldn't be reading into the UK positivity this morning and translating that into a durable trend. I think the move that we're seeing in input prices across the European PMIs today is really the key indicator, and that is telling you that business costs are rising sharply and that they haven't yet passed that fully on to consumers, but their intentions to do so are also rising. So this is some of the timeliest data we've had since the start of this conflict. And okay, services in the UK is holding up a little bit better than expected, but to me, we know that this shock is going to put upward pressure on inflation, it's going to put downward pressure on growth, and the size of that is going to be dictated by how long we're left with no supply coming out of the Strait.
Does that deal a blow when does this start to look like a 2022 inflation shock? I mean, how long does the Strait need to be closed before we're into that sort of territory, or is that simply not going to happen this time around?
This is not 2022, in my view. I think the starting point for the economy when this shock hits looks so different to where we stood back in February 4 years ago. You think about where inflation was at the time. In the UK, we were at 5.5% and rising. This time round, we were much closer to 3%. You look at where interest rates were. For the UK at that time when Russia invaded Ukraine, UK interest rates were at 0.5%. 10-year yields started with a 1. The economic backdrop was so different. Today, you look at labour markets that are significantly softer. You look at the material progress that we've made on inflation. So clearly, inflation is going higher over the next few months. But I personally don't think that 2022 is a fair comparison, just given how much more vulnerable, frankly, the growth backdrop is today versus all of that pent-up demand that was hitting the economy in 2022 and the revenge spending that we were talking about at the time after 2 years of consumers being locked up and parking savings away.
Okay, so we're far away from that situation. I wonder, though, when thinking about the movements that we've seen in the dollar, it has strengthened during the conflict as well, although, again, a bit of a pause since we've had the ceasefire. Where do you see the dollar trajectory going from here? Is this a reversal of last year's trend?
In my view, no. I think there is further downside for the dollar ahead. And to me, the moves in March told you much more about popular positioning going into this shock having to be scaled back rather than any change in the underlying fundamentals. You look at all of the biggest movers over the first few weeks of this conflict. It was gold down. It was the dollar up. Japanese and Korean equities down. It was UK gilts being hit the hardest. Those are all some of the most popular consensus trades, with investors positioning for further upside in gold, further upside in the AI trade in Asia, and expectations of fairly rapid Bank of England rate cuts. So I would not view the stronger dollar performance that we've had since the start of this war as a sign that international investors really are returning to the greenback as a source of a safe haven trade. I think fundamentals point to a weaker dollar. That's a less exceptional US growth backdrop versus the rest of the world. That's more fiscal stimulus coming in places like Europe and Japan. That's interest rate differentials no longer as supportive as well. All of those factors, I think, support a reallocation of capital around the world, which is likely to weigh on the US dollar ahead.
Okay, and in terms of the AI trade, I mean, it's been one of the constant points of strength during this whole crisis. I'm just looking at the ST Micro results this morning, again, very positive forecast, and we heard similar things from some of the other European players in this story as well. Are there any doubts there? Do you know, are you kind of do you suppose it doesn't look as positive as it did before, is what I'm trying to get the words out of my mouth to say.
No, I know what you mean. I guess the question we're asking as a result of this conflict is to what extent the capex commitments from the AI names are going up because of new capacity being added, or the extent to which this is simply because the cost of building, the cost of buying semiconductors and producing semiconductors is going up. And therefore you effectively have cost inflation driving those capex numbers higher. And I think the market reaction to some of the early results that we've seen has actually been pretty telling, in that depending on where you are within the AI ecosystem, you're getting very different results. If you're early on in that supply chain, if you're the memory providers, you're doing very well. Nvidia alone is expected to deliver close to 40% of US earnings growth for this quarter as one company. But if you're further down the pipes, if you're looking at being the purchaser of that equipment, you're being hit harder. You look at the Tesla reaction last night and the way in which a positive earnings release was initially met by a strong market reaction, only for the market then to start to pull back off the back of those increased capex commitments. So investors here are looking for two things. They're looking for, one, companies that are in the right place along that AI supply chain. And then two, for the hyperscalers, they're looking for strong earnings, but combined with capex discipline.